Hello everyone, I hope you are having a good time. And I figured, or at least I decided from this video forward, I'm going to make two consecutive videos for each chapter. That way you have a better time management, so you don't have to sit through the entire chapter. And I realized that it's really hard to watch a video for 2 hours, and for 1 hour it's probably manageable. So if you decided or if you're comfortable with sitting through the entire chapter, you're welcome to do so. And if it's not, it's better for me to cut it into two videos for each chapter. Okay, so I will definitely to post all these video chapter videos in Blackboard, and I will create folders in the course videos folder for each chapter, and I'll post 2 videos in each chapter's folder under the course video folder on Blackboard. Okay, so please check on those videos and make sure you watch all these videos before you do your homework. All right, if you have any questions, please post your questions on discussion board and help me. Other students, please help me to answer questions, and I'll check on the discussion board regularly. All right, so now in this video we're gonna start on chapter 8. Okay, so chapter 8. Now let's start the lecture. Okay. All right, chapter 8. It's about accounting for receivables. Accounting for accounts receivables, and we've been talking about accounts receivables in our journal entries through this semester up till now, and so we kind of have a clear understanding or picture about what accounts receivables are, right? So accounts receivable is really when we sell products or providing our services on credit, and they are going to pay us at a later date, right? So we have an accounts receivable from the customers and from the partners, right? So then the question here is that why would a company extend credits to its customers or its partners, right? So what's the good point, or what's the benefit for offering that credit to the customers, and what are, on the other hand, the disadvantages for offering or extending the credits, right? So the advantage of extending credit or offering accounts receivable is that it helps customers buy products and services, and thereby it can increase the business revenues, right? So for example, if companies is buying products from their partners, and they're saying, hey, I'm not really have enough cash right now to pay all the purchases, and I can purchase them on credits, and when I have cash available, I'll pay you at a later date. So it will be a better cash management strategy for our clients, for our customers, okay, and then it will attract more business to increase our revenues. That makes sense? But the disadvantages for extending credit or offering accounts receivables is that first, it will increase wage costs. Okay, so give me 1 second. Laser point. Okay, so it'll increase wage cost. Why it will increase wage cost? Because if we are extending or offering credits to our customers, to our partners, we have to, or the company at least, have to hire additional people to evaluate whether the customer is credit worthy, or we have to hire additional manpower to track how much each customer owes us, right? And another factor that we need to think of is that we have to hire additional manpower to track and to collect the receivables from each customers, right? So we have to pay more wages and salaries expenses to collect, to evaluate a customer's credit worth. Okay, and second is about the bad debt costs. Okay, bad debt costs. What bad debt costs is that once we extending or once we offer accounts receivables credits to our clients, customers, okay, and they have their ability to pay out at a later date, and once those due dates come up and the customers call up us and say, hey, I'm really having a difficult time here and I'm not able to pay you the full payment before the due, and probably I'm gonna pay a portion of that, or even worse, the customers never called us, and then we just never able to collect the accounts receivables, and then those accounts receivables that are not able to collect in the future will become something called bad debt, and that'll be considered as our costs for business operations. Okay, it's similar to shoplifts for those retailers, companies like Walmart, and employees shoplifts or customer shoplifts, and that business has to bear that cost because it is just the regular cost of doing such business. Okay, it is very, very common cost to do the business, right? So for each company or for each business that they offer accounts receivables or offer credit sales, they have this cost called bad debt costs. Okay, and that will increase costs accordingly, it will reduce our operating income, which hurts our profits. That makes sense? So the last one is delayed receipt of cash. Okay, so if we are extending the credit periods, or we are offering accounts receivables, remember right here, okay, remember when we talk about accounts receivables and then we're talking about the collections, we have some terms like 3/15 and N/60. Remember what this means? Okay, so if you pay within 15 days starting from the date you receive the receipts or bill, or from the date you receive your products, within 15 days, if you pay within 15 days, then you are going to receive 3% discount. Okay, otherwise you have to pay the full amount within 60 days. Okay, so if the customer or the partners receive these incentives, they have options either to pay within 15 days to get that 3% discount, or pay within 60 days. With that being said, that means customers don't have to pay off their accounts receivable or accounts payables from the purchaser side, the accounts payables immediately. They can hold this payment off, on until a later date, and for example 60 days, right? So we, as the business who is selling the products or offering the services, we're not able to receive cash immediately. Okay, so the critical part about a business is the cash management strategy. Okay, if you don't have cash or you ran out of cash, more than likely you're gonna go into bankruptcy. Okay, you're going to bankrupt. Okay, so that's really a critical part of doing business. So really we want to have, or we want to receive cash as soon as possible, and to invest or spend our cash into some new projects or doing some new business and something like that, so to speak. Okay, so that's the other disadvantages if we're offering credits. That makes sense? All right, so let's move on. Oops. Come on. Okay, so now estimate and report effects of uncollectible accounts. If we offer accounts receivable credit sales to our customers, and at the end of the day we are not able to collect those accounts receivables, how do we treat those uncollectible account receivables? Okay, so here is the question. That is the question we are trying to answer in the following slides. All right, you with me? So accounts receivable and bad debts. So two objectives when accounting for accounts receivables and bad debts. So if we are not able to receive those accounts receivables, those uncollectible accounts receivables, how do we treat them? Okay, so remember, we are trying to reflect our assets, liabilities, stockholders' equity as accurate as possible, right? So first, we need to report accounts receivables at the amount that company expects to collect, which is the net realizable value, which is the most reasonable amount that we are going to collect. It's not the estimated amount we think we could collect. It's the with all these factors, with the current circumstances, with the situations of our customers, clients, what is the total amount we think rationally is going to be collected? Okay, that is reporting accounts receivables at the amount of the company expect to collect. And second is match the bad debt expense to the credit sales in the same accounting periods. Okay, so match the costs, match the expense, match the bad debt expense to the credit sales in the same accounting periods. So the matching principle. Remember what matching principle is? That's another term for recognition for expense, right? We have to recognize the expense in the same period in which the cost supporting us to earn the revenues, right? We need to expense the costs out in the same period in where they help us to earn the revenues, okay? So why we have to use matching principles to match that bad debt expense to the credit sales? Because we earned those revenues, for example, in previous month, okay? So if some of those credit sales are not going to be collected, then they become the bad debt expense for the prior period, because that really the incentive to attract the customers to buy our products, which generate us the revenues. Now it becomes the cost. Okay, if we don't offer those credit incentives, probably the customers will not buy the products from us, which at the end of the day, we're not able to earn such credit sales. Okay, so that is the cost to earn the credit sales revenues. That is why we have to match the bad debt expense in the same period in which that we realize the credit sales. Okay, so these are the two purposes. All right, these are the two purposes. First, we need to record or adjust our accounts receivables to the net realizable value, the most reasonable amount we are expecting to collect. And second is to match the bad debt expense to the credit sales in the same accounting periods. All right, that makes sense? If it's not, please let me know. All right. Okay, so in order to match the cost, the bad debt expense to the credit sales, we have to do two-step process. Okay, we have to do a two-step process. That is, first make the end of period adjustments to record the estimated bad debt in the period credit sales occurred. And second, to remove, another word or term for that is write off specific customer balances when they are known to be uncollectible. Okay, so more than likely, okay, 50% or more than 50% probability that we're not going to collect that accounts receivable from our customers. We need to remove the corresponding amount from the accounts receivable accounts for that customer, okay, which we call the write-off, which means we're going to reduce that amount from accounts receivable balance. Okay, but first we have to make an adjustments to record the estimated bad debt expense. Okay, the estimated here you see that it is, excuse me, It's too messy on this part, right? So it is the estimated bad debt expense. Okay, it is not the actual bad debt expense or bad debt cost. It is not the actual cost. It is the estimated based off on the experience or historical information of the company, and usually how much or what the percentage of accounts receivable that is going to be uncollectible. We based off on those information to estimate the amount of bad debt costs. Okay, so remember here it is estimated, not actual. That means some of the information on our financial statements are not 100% actual information. That is based off on reasonable estimation. Okay, reasonable estimation, not just a random guess. Okay. All right. So first step, adjust for estimate bad debt expense. Okay. We look now. Let's look at this example. VFC company estimates $900 in bad debts at the end of accounting period. So how do we record this journal entry? Okay, so first we debit bad debt expense, which is $900, and we credit another account, which is new account to us, allowance for doubtful accounts. Okay, allowance for doubtful accounts is $900, and that is control asset account. Okay, this is a control asset account. Remember, what does contra mean? Contra means the opposite. It is against something, and that is against the assets balance. A specific asset balance, and that specific asset is accounts receivable. So allowance for doubtful accounts is contra accounts receivable balance. Okay, it is a contra accounts receivable account. All right, so it's similar to accumulated depreciation account, which is a contra fixed asset or equipment account. It makes sense? Okay, so remember it carries control asset accounts. It carries a normal credit balance. And when we report those control assets on balance sheet, it has to be reported in the asset section, but it's read below the corresponding asset line. All right, and the value, the ending balance or the balance reported on the balance sheet has to be in the parentheses. Remember? Okay. All right. So here, accounts receivable, the original records record sales on account. So on the first day when we make this sales, we debit accounts receivable because this is sales on credit. Debit accounts receivable for the revenue $120,000 and credit sales revenue for $120. Okay, $120,000. Okay, and then when it's come to the end of January, okay, it is a month end adjustments. Okay, record estimate of bad debt or sales or receivables. We debit bad debt expense for $900 and credit allowance for doubtful accounts for $900. And remember, this bad debt expense, it is not an actual expense. It is an estimated expense. It's based off on historical accounts receivable information or historical information about their customers. Okay, it is an estimated bad debt expense. Okay, it is not actual. Okay, it is not actual. All right, and again, even though I don't think it is necessary for us to go through the accounts. The accounting equation effect for these transactions, but I think it's going to be safe for us to walk through this one more time and walk through the logic and the theory why we debit something and credit another thing. Okay, so now let's go back to the blackboard. Not a blackboard. For Skidmore account, but the blackboard here. Okay. All right. So A plus expense plus dividend equals liability plus common stock plus revenue. Remember, everything on the left hand side of the equation in terms of the T accounts, the increase balance on the debit side and decrease balance on the credit side, and on the right hand side of the equation it increase on the credit side and decrease on the debit side. Oops. Right? Okay. So since we need to estimate our bad debt expense, and expense account is on the left hand side of the equation. If we estimate bad debt expense, that means that specific expense balance will increase. So that means we need to debit the expense, which is bad debt expense. And in this case, it's $900, right? And that is the only thing we debit here, okay? And so we need to finish this journal entry by crediting something. And of course, we know to make this journal entry balance, that has to credit $900, right? The amount will be balanced. And what the account is going to be allowance for doubtful accounts, okay? For doubtful accounts. All right? And that is a control asset account. Asset account increase balance on the on the debit side, which means control asset account will increase their balance on the opposite side, which is the credit side. So we also increase the balance of some accounts, well, mathematically on the right hand side of the equation, okay? On the right hand side of the equation, somewhere here, okay? But really not in this section, okay? Somewhere here on the right hand side of the equation. All right? Okay, now let's go back to the PowerPoint. Okay. So on the balance sheet, here you see we have this section, okay? We have this section, okay? If you have no accounts receivable, inventory will be the first thing you report under cash. If you have accounts receivable, inventory will be the second thing report on the balance sheet below cash, and accounts receivable will be the first thing you report under cash. Okay, so we have accounts receivable balance. Okay, we have accounts receivable balance. That is the total original accounts receivable ending balance, and allowance for doubtful accounts, it is not $900 because $900 is only for this single transaction which occurred on January 1st, and we probably have some other balance that we carried over from previous month or prior year, or we have some additional allowance for doubtful accounts balance that related to the later credit sales somewhere during January. Okay, so that is the total ending balance for allowance for doubtful accounts, which include this $900 and some additional amounts. Okay, so you see that is control asset account, that's against the asset account balance. Okay, that against the accounts receivable balance. So accounts receivable net of allowance reported, the ending balance is the difference between $200,000 and $15,000, which is $185,000. Okay, so that is the net realizable value for our accounts receivables. Okay, so more than likely we are going to receive in total $185,000 in the future out of this $200,000, and that $15,000 occurred from our credit sales will never be collected. Okay, so that will go into bad debt expense somewhere in the future, or progressively, proportionally. All right. And remember, when we report accounts receivables on balance sheet, these three items, you have to accounts receivable, accounts allowance for doubtful accounts, accounts receivable net of allowance. These three numbers, you have to report the section for accounts receivables in this order and in this format. Okay. Or what you can do is you can do a set work to calculate your original balance for accounts receivable and allowance for doubtful accounts, and only report this line, the very last line, accounts receivable net of allowance, that line on your balance sheet. It is okay. You either report this line only or this entire section. Okay, so either one that works. All right. Then on the income statement, in this month we estimated or record bad debt expense for $900. We have to report it on our income statement and expenses out to deducted out from our revenues. Okay, so we have cost of goods sold, and we have gross profit, and we have salary and wages expense, and additionally we have something called bad debt expense that will be subtracted in addition to salary and wages expense, okay, from this gross profit and other expenses. So basically all this section is called selling and administrative expense. Okay, selling and administrative expense. This section will be selling and administrative expense. That is, there's corresponding amount, and we have income from operations. Then next we subtract some interest expense and tax expense. We have net income. Okay, the very bottom line is net income. All right, so bad debt expense has to be reported on the net income, on the income statement. All right. So then next step is to write off specific customer balance. Okay, remember when we have accounts receivable account, we have accounts receivable account, we have a separate or individual accounts receivable account for each separate customer or client. Okay, so that way we can systematically and accurately to track the accounts receivable that each customer owes us, and we can systematically and accurately to track when they should pay how much to us, and we can have our accounting folks or some debt collectors department to try to collect those accounts receivables for us. That makes sense? So now to write off this bad debt from, so the company determines that out of 900 and 800 receivable from the company is uncollectible. So how do we record this transaction? There will be, remember when we record bad debt expense, that is estimated. Okay, so allowance for doubtful accounts, which against accounts receivable balance, which also based off on estimation. Now we figure out really $800 will never be received from the company, so we need to remove this $800 from the balance, from the accounts receivable balance. What we do is we debit allowance for doubtful accounts, okay, for $800, and we credit accounts receivable for $800. Okay, now the estimated amounts of $800 becomes the real uncollectible amount, and we are now taking that out of our accounts receivable balance, okay, through these journal entries. Okay, so what do we do and how we do it? and how does that reflect our accounts receivable balance at the end of the day. Now let me show you the work. All right, so for example, accounts receivable, and let's say we have something balance for $20,000, okay, and that's the ending balance, and allowance account, okay. For simplicity, I don't read it the full name, account name, okay, and that has before it was $15,000, okay, and now we know that the $800 is not by any chance collectible, so we remove it, we write it off from the accounts balance, okay, accounts receivable balance, and then by making this journal entry, debit allowance for doubtful accounts and credit accounts receivable for $800. Then debit allowance for doubtful accounts, debit $800. So we reduced allowance for doubtful accounts balance by $800. Okay, it is a control asset account, carries a normal balance on the credit side, so that will be $14,200 ending balance. And then accounts receivable, we are debiting the $800 amount. So we're crediting, so it will be on the credit side. So then the actual accounts receivable balance now will be adjusted to $19,200. So that way, after this adjustments, that will be the amount we report on our balance sheet. You with me? Okay, so this is how this journal entry affect our accounts balance, corresponding accounts balance. Okay, all right, so you see here, this is gonna be the amount we report at the end of the day. All right, and this is the two-step process to estimate the bad debt expense and to write off or adjust accounts receivable balance. Okay, accounts receivable balance. All right, make sure you understand this two-step process to adjust accounts receivable balance, because at the end of the day, we have to report the balance as accurate as possible. Okay, as accurate as possible. All right, so next is, so we estimate bad debt expense and it's $900, but how exactly we estimate that $900? So what method, what theoretical method we use, or measures we use to calculate that $900, right? Do we just wake up in the morning and then pull up your phone and receive the email says that, okay, we're probably gonna have a bad time next month, and we just make some random guess and says that, okay, I think $900 is gonna be not a collectible? No. Okay, there are several strategies or methods we can use to estimate our bad debt expense. Okay, so there are two acceptable methods in general to estimate the bad debt expense for a certain period. First one is percentage of credit sales method, and second one is aging of accounts receivables. Okay, you see here, the first one is quite simple to apply and it's really easy to understand, and second one is more accurate than the first one, but of course it's gonna be a little bit complicated, but not that so complicated that takes forever for everybody to digest that information. No, but it's gonna be a little bit complicated. So just walk with me, bear with me, let me walk you through this process. Okay, so if you are tired up and you think you need a cup of coffee, or you need to stand up or stretch your legs, or watch some YouTube video clips for fun and to ease your concerns, or or anxieties for now, please pause your video and take a 5 minutes break and come back. We're gonna move on this section, okay? I want you to sit through the entire section when we talk about these two methods, okay? And be ready for that, okay? All right. All right, let's move on to the first one, okay? So percentage of credit sales method is very intuitive. Why? The percentage of credit sales method estimates bad debt expense by multiplying the historical percentage of bad debt losses by the current period's credit sales, which means the formula is credit sales of current month. It's not only the current month, it depends on the accounting period that you are looking at. It could be a month, it could be a quarter, it could be a year, all right? Depends on the length of accounting period you are looking at, okay? So for this example, we are looking at for a specific month, the current month, all right? I really wish I have a touch monitor so that way I can use my stylus right on this PowerPoint directly, but sadly speaking, I don't have that one, okay? It's too expensive for me, all right? So bear with me on that technical issues. All right, anyway, so credit sales times bad debt expense, bad debt loss rate, and estimate bad debt expense, and that will be the amount of bad debt expense we recognized, we matched for that specific month. Okay, why is that? Because we made that much of credit sales only in that period, and accordingly, based off on matching principles and historical information, that percentage of the sales will not be collected or will not be collectible, so that'll be the bad debt expense or estimated bad debt expense for that month only. All right, matching principle, matching the expenses to the revenues that they support to earn in the same accounting period, right? So that will be the bad debt expense cost for that specific period only. All right, you have to recognize that much bad debt expense in that month or in that accounting period. All right, okay. So based off on historical percentage, what is historical percentage? Okay, it's similar idea like a student's past academic performance, right? So if your professors, or if some professors pull up a student's cumulative GPA and says that, okay, the student's overall GPA is a 0.001, and then students in this class saying that okay, professor, I don't really understand what you're talking about, and I don't think that information is making sense to me, and I don't know how to do the work because it's confusing information. And if the professor look at the bad performance overall GPA in terms of that, so to speak, okay, probably that information is not really a legit argument that student made to the professor, right? So it is the historical information that help us to estimate what is the most accurate performance or information we could have for current circumstances or for the future, near short future conditions. All right. So, for example, the company has experienced a bad debt loss of 0.75% of credit sales in prior periods. Credit sales in January total of $120,000. What is the bad debt expense, right? So again, this bad debt expense is not the accurate. It's not the actual bad debt expense. It is a estimated bad debt expense, okay? Estimated bad debt expense, okay? Based off on historical information, historical bad debt loss information, all right? So that is 0.75% of credit sales. And in January, we made a total of $120,000 of credit sales. Then $120,000 times 0.75%, that will be the bad debt expense for January only. Okay, it will not be carried to the next month, the February. Okay, it will not be carried to February. It will not be carried over from December of last year. It is the only bad debt expense we estimated for January, the current month, based off on the current month credit sales. All right, so that is the only current month bad debt expense. All right, so we make this journal entries, which is exactly the same journal entries that we made in the previous slide. Okay, all right. The other method is aging of accounts receivable. So what does that mean? All right. So the aging method gets its name because it is based on the age of each amount in accounts receivable at the end of the period. The older and more overdue an accounts receivable becomes, the less likely it is to be collectible. Right. So what this means is that, for example, if for example, let's say a friend of mine send me an email or text me that, hey, I'm having a difficult time, and could you borrow me like $1,000 and help me to survive next month? I said, okay, you're my best friend, right? So I quick pay $1,000 to my friend, and he said, I promise I'm gonna pay you at the end of next month. All right. So now it's come to the end of. Okay, so next month from now it's gonna be April, right? The end of April. So now let's say now we are at the end of April, and more than likely he's gonna pay me back about for that $1,000, right? But until now I haven't heard from him back about that $1,000. Okay, so now I think, okay, still I give him a little bit time for him to get those in cash and to pay me back, right? And then 15 days later, I didn't get anything from my friend, okay? And another month passed by, I still haven't get anything back from my friend. And a year later, do you think I still have a higher chance to get that $1,000 back from him? No, right? Probably I will never mention this $1,000 to him later on, right? So less likely I'm gonna have those $1,000 back as the longer period I'm waiting for. Make sense? So that is the theory behind the aging of accounts receivable. Okay, so first, each receivable is grouped by how long it is past its due date. And second, each age group is multiplied by its estimated bad debt loss rate. And third, estimated bad debt for each group are totaled. Okay, I'm gonna walk you through an example on this, but the idea of these 3 steps is that, okay, so we no longer group our accounts receivables by customers, by clients. We are going to group our accounts receivables by the length that past is due. Okay, so for example, I have 3 clients. I have 3 accounts receivables for 3 different clients, and then each one have some accounts receivable overdue for a month, and have some accounts receivables overdue for 3 months, and some have overdues for like a year. So I will add them up, the total accounts receivables, and figure out in total of these 3 accounts receivables account in total how much of that total amount is overdue for 30 days, and how much of that is overdue for 6 days, and how much of that is overdue for a year. That makes sense? And second is each age group is multiplied by its estimated bad debt loss rate. Okay, so after we group them by the length of passing due, it doesn't mean that all of those accounts receivables that past due for a year already will not be collected at all. Okay, some of them probably it's because our clients just forget to pay us back, and some of them just probably because they misplaced their invoices somewhere. Okay, and then a year later they locate it and they pay us back. Okay, so based off on again historical information, what is the percentage of a certain age group that is not collectible? Using that information, we calculate for each age group how much bad debt loss could be for that specific age group. Okay, and then we add them up. In total, we add them up. The bad debt loss we calculated in step 2. And then add them up to estimate the total bad debt expense, or total uncollectible bad debt. Okay, uncollectible accounts receivables. However, here is the confusing part. Okay, here is the confusing part. This calculation, when we add up all these uncollectibles, it is not the bad debt expense. It is not the bad debt expense for current period. Okay, it is not the bad debt expense for current period. Why is that? Because we grouped in first step, we grouped all these accounts receivables by the length of passing due, right? So those accounts receivables could be from the sales, credit sales in this current month, or could be from the months of previous month, or could be from last year. Okay, so those accounts receivables grouped by the length of passing due could be from anywhere. Okay, could be from any accounts period. Okay, accounting period. Okay, so it is no longer, excuse me, the weird accent. Okay, I mean the weird tone. Okay, I still have it. Forgive that. Okay, so this total estimated bad debt, it is not for current period. Okay, it is overall up to date how much in total we estimate are not going to be collectible. Okay, that makes sense? All right, with that being said, all right, so now let's walk through this, okay, with an example. For example, this company, the VFC company, has 4 customers. That means each customer we're going to create a separate accounts receivable for each one of our customers. Okay, and for Adam Sports, oh, come on, Adam Sports, for Adam Sports we have accounts receivable $700 from Adam Sports, and out of this $700 accounts receivable, $400,000 of this $700 has past due of 30 at least within 30 days. All right, and $200 of this $700 accounts receivable at least past due 31 days already. Okay, and the other $100 at least past due for 61 days already. Okay, so you add these up, it equals $700. Okay, $700 grouped by age. Okay, the length that past due is $400 past due within 30 days, $200 past due longer than 30 days but less than 60 days, and $100 longer than 60 days but less than 90 days. All right, and the second accounts receivable is for this customer, and that's in total $2,300. So none of this $2,300 passing due for the first 3 age groups, but all of them is past due over 3 months already. So that's a really lazy customer. Okay, you probably do not want to do business with him anymore. But others, okay, not shown to save space, which means they have more than 4 clients here. Okay, you have more than 4 accounts receivables here. Okay, just in total, for other clients we have $199,000 accounts receivable, and out of that, this amount past due within shorter than 30 days, and that amount out of 199,000 past due more than 31 and less than 60 days, and that for the third age group, and that for the fourth age group. Okay, and for this last customers, okay, we group by age. Okay, 4,000 to 2,000. Okay, after we group all these accounts receivables by group, then what do we do is, and all these numbers are based off on percentage. Okay, based off on percentage. It could based off on the percentage, historical percentage for each individual clients, or it could be based off on the historical percentage for each different industries, or it could be different percentage for the total clients accounts receivables. All right, either way that works depends on the company's policy. All right, as long as that makes sense to the company and it's persuasive to their investors and auditors, that works fine. All right, so next step, and this based off on the percentage we already calculated. Okay, I'm sorry, on collectibles. Okay, and we estimate that percentage. So this is estimated based off on the general age group. Okay, the more detailed information, the more accurate, right? So and this one is based off on the general overall accounts receivables. Again, as I said, you could use those historical percentage for each one of those clients or customers, or for each specific industries, whatever. Okay, or geographic locations. All right. So in this example, 1% of those first age category are not going to be collectible, and 10% for the second age group, 20% for the third age group, and 40% for the fourth age group. Okay, as the days past due becomes longer, okay, and the uncollectible rate becomes higher, becomes greater, right? So it makes logical sense. All right, so 1% of $120,000 is not going to be collectible. Okay, 10% of $45,000 is not going to be collectible, and we calculate that. Okay, it's going to be $1,200 for the first age group, $4,500 for the second age group, and $7,400 for the third age group, and then $2,400 for the last one. All right, and then we add each one of these together to get total uncollectible, which is $15,500. That $15,500 means at up to today. Okay, up to today, in total we carries $15,500 uncollectible in on our balance sheet. Okay, on our balance sheet. Okay, it is not from the current accounting period. It is not from the current accounting period. It is from all the accounting periods starting from the first accounting period up to today. Okay, so that will be the ending balance for allowance for doubtful accounts balance. All right, so what it means is that, okay, so the $14,200 balance is before we make this estimation. At the end of the day, we have that much, and pretty much and 99% of time in our class, this $14,200 unadjusted balance, it is the adjusted balance from prior period, which is based off on the similar calculation here from last month or from last accounting period. All right, and this $15,500 at today, the end of the current accounting period, it is the total balance we are carrying now. That includes every piece of uncollectibles from the first day of business operation up to today. All right, and at the end of last accounting period, we have that much uncollectible, 14,200, and at the end of today we have $15,500 in total for uncollectible. Then how much more uncollectibles we have during this current period? That makes sense? How much additional uncollectibles we have made during current period, which is going to be the difference between last accounting period ending balance and the current ending balance, which is the difference of these two numbers. All right, so $15,500 minus $14,200, whatever the difference is, forgive my math, okay, $1,300, that will be the bad debt expense, estimated bad debt expense for current period only, because from the last period uncollectible amounts, and we estimated total of $1,300 will not be collectible from the credit sales we earned during current period, and add these two up together, it runs up to $15,500 estimated allowance for doubtful accounts, uncollectible accounts receivables amounts. All right, so what do we do is bad debt expense based on aging of accounts receivable method. Bad debt expense will be $1,300 for current month, okay, for February 28th, the month of February, okay, and we credit allowance for doubtful accounts, control asset accounts, control accounts receivable accounts, $13,000. Okay, so allowance for doubtful accounts adjustments, which is $1,300, we ran up to $15,500, which is the total balance we calculated using aging of accounts receivable method from the previous slides. All right, and then bad debt expense now. The beginning balance, bad debt expense, okay, it's $900. Remember, that is the January bad debt expense, okay, and we made bad debt expense adjustments for February, and in total is $2,200 bad debt expense. And some of you may ask this question, okay, I think bad debt expense and any expense accounts are temporary accounts, right? And why beginning balance now is not zero instead of it's $900? Because even though expense accounts are temporary accounts, but at the end of the day, we are going to make a fiscal year and financial statements, and this is so far only for monthly balance. Okay, we need to accumulate all these balance up to the end of fiscal year or up to the end of the operating cycle of the business, and then to make the annual or fiscal balance sheet, fiscal year-end income statements, and then we can have a fresh start. Okay, we can have a fresh start. All right, that is the time when we reset all these temporary accounts, not from month to month. Make sense? All right, so summary, the allowance method. So first, we are going to estimate bad debt expense for each month, at least for each month, okay, at least for each month, okay, and you could do for each quarter or semi-annually, and for at least you have to do bad debt expense estimation and to do these adjustments monthly and yearly, okay, and depends on the company and business nature, you're probably going to do quarterly and semi-annually, okay. And then to estimate bad debt expense is debit bad debt expense for whatever the estimated amount is, and credit to allowance for doubtful accounts. And to write off, to remove that specific amount from accounts receivable, we are going to debit allowance for doubtful accounts and remove it from that balance, and then actually deduct it from accounts receivable balance. Okay, this is what this journal entry help us to do. Okay, and remember to estimate bad debt expense, this is always going to be the journal entry you make. Okay, to estimate bad debt expense, this is going to be the journal entry you make always, okay, it's always true, okay. All right, and this is always going to be the journal entry you record to write off the balance, okay, to write off the balance for accounts receivable, all right. Okay, other issues, okay, so the prior slides were talking about how to estimate bad debt expense and how to remove it from accounts receivables. And the reason is that we have to estimate the cost for doing business in the same period, right? To following matching principles, and then we have to use, in general, the conservative accounting principles to reflect the reasonable amount on our financial statements, right? But at the end of the day, it is our estimation, even though it's based off on some rational, relatively accurate historical information. But at the end of the day, it is not a pure 100% accurate information, right? So sometimes, okay, for example, my friend, he just not having good memory, okay, so and 10 years later, and when he wakes up in the middle of a night, and he remembered that he owes me $1,000 from 10 years ago, and he called me up in the middle of the night and says, hey, I'm gonna pay you back that $1,000. Okay, luckily I'm gonna get that $1,000 back, but if you factor in that inflation, it's not really worth $1,000, sadly speaking. But anyway, my point is that some companies are always going to pay back some of the bad debt expense you already estimated before at a later date. Okay, after we record those bad debt expense into our financial statements. All right, into our financial statements. Then if they pay back those amount that we have already estimated, that we already expensed out, and we already removed right off from our balance sheet, how do we do the corresponding transactions? How do we adjust those amounts into our financial statements? Okay, so that is the issue, that is topic we are going to talk about for the following slides, okay. Revising estimates. Bad debt estimates always differ from the amount that are later written off. If these differences are material, companies are required to revise their bad debt estimates for the current period. For example, if the actual written off amounts is $10 different from your bad debt expense, it is not substantial, and don't worry about it. Okay, probably if you're so nice that you want to have informed your investors and public, you can put that into notes, okay, the disclosures of your financial statements. Otherwise, you don't have to worry about it, okay, you can just ignore it. But let's say you report your estimated bad debt expense for like $1, and then at the end of the day, your bad debt cost, you write off $1 million from your accounts receivables, or vice versa, that you estimated $1 million of your bad debt expense, which means you're gonna have a tremendous lower amount for your net income, and accordingly you're going to pay far less amount of tax, right? So that can be manipulated. So, and then at the end of the day, you only have $1 read off from your accounts receivables. That difference is tremendous, it's substantial, right? So in that case, we have to adjust our bad debt expense to adjust it to its a relatively rational level, okay, and to adjust your net income to its relatively accurate level, and then to pay relatively accurate income taxes. That makes sense? Okay. And accounts receivable, collections of previously written off accounts is called a recovery, and it's accounted for in two parts. First, put the receivables back on the books by recording the opposites of the write-off. Second, record collections of the account. Okay, so what it means, all right? So reversed the write-off. Okay, reversed the write-off. What do we write off? What journal entries we use to write off? we read off. Give me 1 second. Let me erase my board. Okay, let me show you that from journal entries from the previous slide. Okay, so we remove, or we read off accounts receivable balance by debit, allowance for accounts receivable. Okay, and we credit accounts receivable for certain amounts, right? So that is the journal entry we made to write off our accounts receivable balance. But once we receive some of uncollectibles back, we need to reverse this entry. Okay, we need to reverse its entry to reflect that we receive that amount back at a later date, and which is the journal entry. This is which the journal entry we make to adjust to reverse the write-off. Okay, debit accounts receivable, credit allowance for doubtful accounts, which increase accounts receivable balance by the amount we received at a later date from our customers. Okay, all right, we receive that. We first reverse the write-off. That means, okay, for those that we are not going to be collected, okay, now those $800, okay, it's still collectible. Okay, it is still collectible. First step, it becomes collectible. Okay, even though you receive cash already, that $800 cash, you now receive that already. It's sitting in your bank account balance already. But the first step is to reverse that amount into collectibles. Okay, so the theoretical or logical process is it will become accounts receivable first, it will become a collectible first, and then second, the collectible is collected. The second step is the second process or mental process is it is collected. Collectible, now it is collected. Then we to reduce accounts receivable amount and increase cash amount, okay, to record receipts of receivables. Okay, the amount that we received, increase cash balance and decrease accounts receivable balance. All right, so those are the two journal entries that we need to make once we received uncollectibles at a later date after we report estimated bad debt expense and we read off our accounts receivable balance. All right. Okay, compute report interest on notes receivables. Now that'll be the topic for the second video for chapter 8. Okay, so now it's enough for the talking. Let's do some exercise. Okay, you have to do this exercise with me. One more time. Only by watching me doing all this work, you will not get those concepts and materials intuitively and right away. Okay, accounting, that means that practice. Okay, always practice is your friend. I cannot thinking and talking at the same time. Okay, but that would be the problem. I mean, the practice problems we're going to work on for so-called in-class practice. Okay, this is on page 374. Okay, 374. Oops, too thick. All right, it is on page 374, and it's mini exercise 8-7. Okay, if you cannot see this questions on your screen clearly or easily, you're welcome to open up your book and open up your book to that page. All right, so this question: assume the company had credit sales of $250,000 and the cost of goods sold of $150,000 for the period. Simple uses the percentage of credit sales method and estimate that 1% of credit sales would result in uncollectible amounts before the end of accounting adjustment is made. The allowance for doubtful accounts has a credit balance of $250. What amount of bad debt expense would be company recorded? Would the company record as an end of period adjustment? Okay, adjustment. So for this allowance for doubtful accounts, that balance of $250. Now let me read that tier accounts first. All right. So that account, I'll write short. Okay, for this account. Doubtful accounts, not accounts receivable. DA. All right. Doubtful accounts, and that carries a credit balance because it's a control asset account. Oops, where did it go? Okay, so it has a credit balance of $250. Okay, $250. Okay, and now let's estimate the bad debt expense. Okay, so using bad debt percentage, the percentage of credit sales method. Okay, our credit sales for the current period is $250,000. That is our current credit sales, and the bad debt as percentage is 1%, right? 1%. So which means it's $2,500 will be the bad debt expense for current period. Why is that? Because that $250,000 is the credit sales earned in current period. Okay, so 1% of that $2,500 will be the current period bad debt expense. All right, so that will be the current period bad debt expense. So then this is the month end or accounting period end adjustments. Then we need to make these adjustments here on the credit side in allowance for doubtful accounts balance. Okay, so in total, at the end of the day, the company will have $2,750 ending balance for adjusted ending balance for allowance for doubtful accounts. Okay, so that means when we prepare financial statements, this will be the amount we report on the balance sheet on the line for allowance for doubtful accounts, which is the line right below accounts receivable. All right, not this amount. This is the amount, $2,500. It is the amount for recognizing our bad debt expense for current period. All right, this $2,750 will be the amount we report on the balance sheet. This is the ending balance. All right. Now let's come on. I apologize if the noise scares you. Okay. Sometimes it's just, things are unpredictable. I'm using my, I probably told you this, I'm using my Surface Go as a wireless monitor to record this video. So sometimes, a lot of time actually I'm having hard time, to have a real-time response from this wireless monitor. Okay. Anyway, so next problem. Okay, so it's exercise 8-6, and it is on page 376. Okay, it is on page 376 in your textbook. All right. So The company used two aging categories to estimate uncollectible accounts. Amounts less than 60 days are considered a young group and have a 5% uncollectible rate. And accounts more than 6 days that are not collectible are considered old and then have a 40% uncollectible rate. Okay, so you have young, which is 5%, and you have old for 40% uncollectible. Okay, so now first question is if the company has $100,000 of young accounts and $400,000 of old accounts, how much would be reported in the allowance for doubtful accounts? How much would be reported in allowance doubtful accounts? Make sure that we don't miss any information here on the top. Okay, all right. So I have this $100,000 for young account which has 5% uncollectible rate, and then we have this $400,000 of old uncollectible and it's 40%. Then we do the calculation. 5% of that will be how much is that? 5,000. Yeah, that's $5,000 for young accounts, and 40% of $400,000 will be $160,000. Is that right? Okay, check my math. All right, and then in total, that will be $165,000, which is the ending balance for allowance for doubtful account. Okay, that'll be the ending balance. Okay, that'll be the ending balance, the total uncollectible. Okay, estimated uncollectible. All right, so that will be for question 1. All right, and then second one is if the company allowance for doubtful accounts currently has an unadjusted credit balance of $40,000, how much should be credited to the account? Okay, what it's saying here is that we have this allowance for doubtful accounts, and now the unadjusted balance is $40,000, right? Unadjusted balance. Okay, unadjusted balance. Unadjusted balance. And then from the first question, we calculated $165,000, which is the ending uncollectible, which is the ending uncollectible. Okay, so unadjusted balance is the previous period ending balance, adjusted ending balance, and from $40,000 and move to the end of current period, and we in total have $165,000 uncollectible. And how much more uncollectibles we have recognized in the current period, right? Which is how much additional we made in this period. Adjusted ending balance, okay, for current period, which is going to be the difference between these two numbers, right? The difference between these two numbers, which is going to be 165,000 minus 40,000, which is $125,000. So in total, this during this month we recognize $125,000 bad debt expense. Okay, bad debt expense. Okay, that is the second question asked. That is what the second question asked. If we are going to make this journal entry moving forward, it's going to be debit bad debt expense for $125,000, and then credit allowance for doubtful accounts for $125,000. Again, our calculation is based off on this process. Our calculation is based off this calculation. Okay, but this adjusting journal entry is right here from this process, okay, which reflects our ending balance as that much. Okay, all right, so now let's look the top. What's the question for, what's the third question? Okay, so if the company, number 3, if the company's allowance for doubtful accounts has unadjusted debit balance of $5,000, how much should be credited to the account? How much should be credited to the account? All right, so very similar to the second one. If we have allowance if we have a debit of $5,000 balance, and what we want to have at the end of the day is 165, okay, then how much we should adjust on this part? That makes sense? So that means this will be debit, this is credit, that will be decreasing the balance, they will be increasing the balance, right? So really here is, mathematically speaking, really is, we have something negative. How much should we add up to get $65,000, that much, right? So x equals 65 plus 5,000, which is gonna be this adjustment using a different color, okay, and that is $170,000. Okay, so that'll be the answer for number 3. All right, and now let's look at number 4. Number 4 is, what is it? Is explain how the company's allowance for doubtful accounts could have a debit balance. Okay, explain that how the company would have a debit balance. Okay, now I want you to pause this video, and probably you can reach to internet, or you can go back to the theoretical part of discussion in the textbook, or from the PowerPoints, and think about this. All right, and then come back with my discussions. All right, so basically is that, now you can pause. All right, so basically is that if we have a debit balance for allowance for doubtful accounts because we estimated more bad debt expense and we adjusted more, and then we actually uncollected. All right, so then we're probably gonna do that. We're gonna end up with a debit balance for allowance for doubtful accounts. So pretty much that is the explanations. All right, and we read off too much accounts receivables. Okay, so that's what it is. All right, what is the next question? oops, what happens? Okay, next question here is record and report allowance for doubtful accounts using the percentage of credit sales and aging of accounts receivable method. So allowance for doubtful accounts using the percentage of sales. I will not use this. I will not walk you through this method, but only I'm gonna show you how to do the aging method, okay? Because the first one, the previous one is exactly the percentage of credit sales, all right? So this one, okay? Oh, oops, nope, sorry, my bad. Okay, the first one is this. The previous one is the aging method. Okay, the first one is aging method. Okay, and here is oops. It's getting so slow. Where is my question? Okay. And here, this one for exercise 8-8, I will only do this percentage of credit sales. Okay. So the company has sorry, bear with me. Come on. Okay. All right. Company has been using the percentage of credit sales method to estimate bad debts. During November, the company sold services on account for $100,000 and estimate that 50% of 1% of half of 1% of those sales will be uncollectible, and prepare the November adjustments entry for bad debts. Okay, so that's quite easy, right? So that's how much? 100,000 times 0.5%. Okay, half of 1% is 0.5%. Okay, so that equals how much? 500, right? 500. Okay, so 500, and now we debit bad debt expense for $500 and credit allowance for doubtful accounts for $500. Okay, and starting next month, and the second part and third and fourth, these three parts, I would like you to work this by yourself. Okay, and please post your answers in the discussion board on Blackboard. Okay, you can post into the fun place, or you can post into chapter 8 discussion forum. Okay, chapter 8 discussion forum for materials. Okay, not for homework. Okay, and this one, record the write-off and the receivables. Okay, it's just to follow the slides and do this in-class practice on your own as well, and post your answers into the discussion board as well. All right, so I'm not going to walk you through this journal entries, because it's just straightforward journal entries. All right, so now please do not forget to watch the second video for chapter 8, which is going to talk about interest on notes receivables, and we're going to talk about what's notes receivables, and we're going to talk about the difference between accounts receivables and notes receivables. All right, now have a good time, and if you have any questions about the first section of chapter 8, you are welcome to let me know, and it's better to let me know as soon as possible. All right, okay, I'll see you in the second video.